Okay, I'm very glad that you joined this way. Hoping this will be an interesting discussion, an educating one. We'll wait another 2 or 3 minutes for people to join, and then we'll get started. What I'll do today is I'll start with my presentation. I'll talk about 30 seconds, and then I'll open the lines for a Q&A. So get ready with your questions. And I hope we'll have a lively discussion and an educating one. Actually, I haven't done a live session in more than a year, so I think this is a new endeavor that we're doing for most of you. I'm very glad to be back to doing live discussions, and if this will go well, then I'll do it on a regular basis. So I'm hoping this will go well. So I think it's time to get started with my presentation. If you have anything to say, or you want to ask questions, or you don't hear me well or anything, just write me a note on the chat box. I'll be taking questions later on, so I'm not stopping my presentation. I'll talk for 30 minutes or so straight, and then we'll go to the Q&A session. Now, I've been getting a question why we're doing this in English and not in Hebrew, where I see most of the people are joining in from Israel, my home country. We're doing it in English. This is broadcasted to all my readers and members all over the world, and it will be also, the replay will be available on the website. So we'll keep it in English, and I'm hoping that's not a problem for anyone. So without further ado, we'll get started. So as I said, I'm going to speak for about 30 minutes, and then we'll open the lines for some of your questions and to an open discussion. So I'll share my screen. Hold on until we get this technical stuff right. Okay, and I'm hoping that you're seeing the screen that I'm sharing, or if not, you'll see it in a short while. And I call my short presentation here, Quant Investing During a Market Crisis. So if you're about my age, or a little bit younger, or a little bit older, then our investing life looks like this. So I'm showing here the S&P chart from the early 90s until these days. And during my investing life, and during, I think, most of your investing life, we've experienced during our life 3 main major market crashes. So the first one you see here, it was in the early 2000s with the dot-com bubble burst. And the second one was the debt crisis of 2009, 2008. And the COVID-19 situation is like what we're experiencing now, and this is the 3rd major decline during our investing lifetime. And the question that everyone asks itself, and the financial media is dealing with, is what will the market do next? So are we in a bear market, and or is it just what we're seeing in the last 2 weeks or week and a half, the upside and appreciation of about 20%? Is it like a V-shaped recovery and the market is going higher from this point on? Or is this a dead cat bounce and the market is due to go lower until we don't know where? So nobody knows to answer that question. So it helps to look at the history and think rationally what we can do and how should we play this situation where we don't know how it will end. So let's look at the biggest declines of the S&P 500 during the last 50 years. So we're seeing here in the chart the market declines since the mid-70s until today. And we're seeing that the biggest declines were in 87, where the market went down 33%. And then during the last 20 years, we've seen almost 50% decline during the dot-com bubble burst. and more than 50% decline during the debt and credit crisis of 2007 to 2009. So where we are today compared to those crashes, the market has hit a peak in February 19th, and the SPY ETF reached $338 a share. Now, the local bottom that we've seen was just a month after that, when the market declined 34% to $223. But since then, since the end of March until yesterday, until today, we've seen a bounce, we've seen an appreciation of prices, and now the market is 16% lower than its peak. So that's why it's kind of iffy whether we're in a bear market and the market is going down from this point and on, or are we done with this decline? It was a 34%, but it was really quick. It took only a month, and now we're in the midst of the recovery. Nobody knows. Let's look at, it helps to understand if the market is overvalued or undervalued. Just it gives another point on whether the markets are bound to decline further, or are they already cheap enough, and most chances are that they will appreciate. So let's look at the market valuation. And I want to start with a valuation metric, which is like the most prominent one. It's what the media quotes the most. It's the Shiller S&P 500 price to earning multiple. Which means this is the price to earnings of the S&P 500 companies in aggregate, adjusted to inflation. And I'm showing the chart from yesterday, so it's pretty recent. You see here the price to earnings, the P ratio of the S&P 500 since the 1880s, or even before that until yesterday. And we're seeing here is that the market today at 26 price to earning is not cheap at all. Actually, it's pretty expensive. If we look on the history of the last 150 years, we're seeing that it has never traded at such high multiples except two episodes in history. One was the late 1990s with the dot-com bubble, and the second one was the late 1920s with the stock market bubble. So only in those two market episodes, the market was so high. So from a Shiller PE perspective, the market today is not cheap, even after the 16% decline that we've seen in the last few months. Now let's take another multiple to assess if the market is cheap today or is it expensive, and that's the S&P 500 price to book. So on a price to book perspective, I only have data for the last 20 years from 2000s. And here we're seeing that a market is not cheap as well. It's trading at 3.15x price to book, an aggregate of all the S&P 500 companies, which is a proxy for the entire stock market. And we're seeing that it's not cheap as well. Actually, it's more expensive than the last 20 years, except two episodes. First one is when the market was overvalued and starting declining during the early 2000s. This was amid the dot-com bubble burst. And the second episode is lately, the last 2 years, where the market appreciated a lot. And I want to remind you that most of the appreciation was in technology companies, was in Facebook, Amazon, Google, and all those big tech companies, which we know that their price to book multiple is very high. So that explains why the multiple was high in recent years. Now, I've written a blog post that you can find on taldavidson.com on my blog, called The Crystal Blog, and I really recommend that you read it. In that blog post, I'm asking a question: what will the market do next? And my answer is an answer that I'm quoting from Jason Zweig. And he says, I don't know and I don't care. So who is Jason Zweig? Jason Zweig is a columnist in the Wall Street Journal. And actually, Jason Zweig wrote a commentary on Benjamin Graham's The Intelligent Investor. So I'm showing my copy. And I think it's pretty small, but this is an updated version with commentary by Jason Zweig, again, a columnist from the Wall Street Journal. And he says that whenever someone asks you what the market will do next, you should tell them, I don't know and I don't care. Will the market go up tomorrow? I don't know and I don't care. Will the market decline for the year? I don't know and I don't care. And why is that? That is because we're long-term investors. We're investing for years. We're building a nest egg. We're building a pile of capital. And we want to see our capital appreciate over the next decade or maybe 2 decades or over a lifetime of investing. So we shouldn't be cognizant and we shouldn't care about whether the market is going up tomorrow and whether we're going through a decline or what does the market do in the short term. And I think I basically adopt this situation. Okay, I think that none of us should be checking our portfolios day to day. It has no value. It can do only damage, no good from checking your portfolio day to day. But with some caveats, and I want to discuss those caveats today during this presentation. So I think that everyone should be prepared to a market crash. You should have your portfolio be prepared for a black swan situation, like we've seen in a decade ago and like we're seeing today. And in that blog post, which actually I published it first in a newsletter that I sent to my premium members on January 2020, before anything crashed. So I list 6 things, 6 pillars that everyone can utilize in their portfolio to prepare themselves for a market crash. The first one is investing rationally using time-tested algorithms. So I think that's trivial because if you look at my website, if you read my blog, if you read the research that I'm writing on taldavidson.com and also on Seeking Alpha, every one of my algorithms, every one of my screener is time-tested. Everything is based on research. On every screener or model or algorithm, you'll see backtesting results. And I do those very prudently. I do extensive research, extensive testing. I'm completely candidate open, and none of it is BS. So investing rationally day to day as a way of life is one pillar of preparing yourself for a market crash. The second pillar is keeping a long time horizon. And here I totally in agreement with Jason Zweig. You shouldn't be investing the money that you're saving aside for dental work, to buy a new car, to fix your car, to stuff you need for money you need for to attend your kids, or to live through a period of unemployment. So you should have a cash pile aside just for that emergency situations, and keep investing for the long term, the capital that you don't need day to day. And long term is at least 5 years. Long term is more of a decade or things that you don't need for the foreseeable future. The third pillar is diversification. Now, you know, among value investing circles, it is commonly said that diversification is the only free lunch in investing, and it is so. Nobody should waive or avoid diversification. It's free, and there's an abundance. If you read my website, there's an abundance of cheap stocks, of great investing situations, especially if you're small investors, you're small money managers, or you invest for yourself. So you are not restricted to buy only the Bank of Americas of the world. You can buy small caps. So there's enough stocks out there that you can buy. So there's no reason whatsoever to avoid the diversification. And diversification will keep you away from idiosyncratic risk of specific companies. Like if one company goes out of business because they had a fraud, they were engaged in fraud, or they have an SEC review going on, or they took some lousy decisions, then you're protected because you're diversified. Now, when there's a black swan situation and the whole market declines, diversification will only help you for some extent. It will help, but it will not protect you entirely. And even if your portfolio is diversified, although it may decline less than one single stock or a less diversified portfolio, it will still decline as an aggregate. The fourth pillar, and maybe one of the most important ones, and we'll discuss that, is keeping some cash aside. That's called dry powder. Having some cash aside means that you have optionality, that you can use your money when prices are dirt cheap, and you can use them to buy assets. And when the market crashes, it helps to wait and catch those stocks when they're dirt cheap. Because when you buy really cheap stocks, and I've seen that in 2009, when you buy very cheap stocks at absurd prices, then they go up tenfold. They go up 500%, 600%, 700%. And I'm pretty sure that some of the stocks, if we wait for them to decline further, today, some of the stocks that I have on my screen, we just need to be patient and buy them bit by bit, piece by piece. Some of them will decline, they will be a multi-bagel, 200%, 300%, 500%, I don't know what, but I'm pretty sure that some of them will appreciate in a very big way. So keeping some cash aside is keeping the optionality to earn life-changing returns later on. The fifth pillar is preparing mentally by studying history. So I'm going to propose a very interesting experiment. Go and read articles about the markets at the end of 2008 and on January and February 2009. You'll be amazed with what you find. Well, search for Google, search for time frame, use the time frame feature in Google search. Search for articles about the market in the end of 2008 and the beginning of 2009. What you will find there is you will find extreme pessimism. You will find articles saying this time it's different. The market is never going to return to normal. We're living in a new normal. And the stock market is not a place for anyone, for any normal person to invest in. And the world is going to end. Complete pessimism. And when there's such extreme pessimism, then it is likely that the market has bottomed down. And that's what happened in 2009. Now, if I'm looking at the articles today, what I'm seeing is optimism. I'm seeing stimulus. I'm seeing there's a vaccine on the way. There's treatment for COVID-19. Everything will be all right. It's a V-shaped recovery. I'm seeing optimism. I'm not seeing pessimism. Now I don't have a crystal ball. I don't know if the market will go up or go down, but it doesn't feel to me, that's my personal opinion, it doesn't feel to me like a bottom. I've lived through the 2008, 2009 crash. I know what a bottom feels like. A bottom feels like depression, extreme pessimism. You know, when I lived through the bottom, I didn't want to open my account. I didn't want to see my stocks declining. It was depressing. And it's not depressing today, at least as far as the market goes. So prepare mentally for a crash. Always study history. That's the fifth pillar. And the sixth pillar, which I'll discuss today, is considering a trend following system, a market timing system. Now, what was my old system, the system that I had during 2008 and 2009 crash? It was do nothing. So you see here the chart of 2008, 2009 crash. Basically, I was fully invested. I mean, I had some cash aside for emergency stuff like dental work, fixing the car, being unemployed or whatever. I had some cash aside, but my long-term capital was fully invested 100%. And then I had to live through all the decline and see my stocks. I had small caps. I've seen my stocks go down 70%, 80%. Some of them went down 90% during a year and a half. It took a year and a half of depressing situation to see my hard-earned assets decline almost to nothing during that time. And I didn't sell. I was young, I was employed, I had some money aside, and I had temperament. I think I had the temperament to stay invested, and I didn't sell anything. And then I had to wait almost 2 years until the market got back to the same levels, and I was in the black again, or you can say in the green again. So it was like 3 years or more than 3 years of seeing your portfolio in the red, losing a lot of money and doing nothing, not selling. Now I can tell you this is very hard, but I lived through it. So I know that I can do it. I can do it again. Okay, I can be fully invested and live through 3 years or 4 years of seeing my portfolio in the red and not sell in a loss. So do nothing was my old system. But since that crash of a decade ago and today, I've done some research and I've learned some new things. And one of the things I've learned is about market timing. Now, market timing is a system which says when you see signals based on research that indicate that a crash is likely, get out of the market. And when you see the opposite signals, go back and be invested. So the professional term is when the signals are positive, risk off, meaning go out of risk assets like investing in the stock market. When the signals are opposite, buy risky assets like stocks. So it's risk on, risk off, risk on. And the summary of my research, and it's very extensive, it's long and it's extensive, it's based on other research, and I share it openly and freely on my website. So you can look at the taldavidson.com dashboard on your members dashboard and scroll down and you'll see there an article called Spotlight on Market Timing. And I list all the research that I've done there. So let's look at some of the main conclusions from that research. What we see here in blue, in light blue, is the S&P 500 graph in the last 20 years. And you see all the declines here in 2009, you see the declines in the early 2000s. Now, the first and most simplistic signal is using a simple moving average of 200 days on the S&P 500. Meaning, if the S&P is trading below its moving average, 200-day moving average, you get out, you take your money out. And if it's trading above this moving average, you put your money in, you invest again. So you see it here in red. So you see that if I had used this signal, I would have exited the market during the 2000 crash and during the 2008 crash, and I would be out of the market. But in total, looking at 20 years, my returns would be slightly lower than my returns had I not used any market timing system. So we see here that the red is lower than the blue, but not by much. And yet I was able to live through without experiencing this 50%, 60%, 70% decline during the crash. So that's one market signal. That's very simplistic. Another market signal is what you see here in green. So I called it UI. It's actually, it stands for unemployment indicator. And using this signal, what I do is I exit the market when the unemployment rate goes above the yearly average of unemployment in the US. So I'm using the US as a benchmark here. So you see here that this market timing signal is much better. If you look at 20 years, and that's the data that I have. Had I have data from the 60s, I would use it, but the data that I have from this research is only from 1999. So using the 20 years of data that I have, we see that the green is much higher than the blue, meaning that overall the returns of investing in the market using that signal are much better than not using that signal. And you see here, and also the drawdowns are lower. So you can see here in the chart below that the UI indicator is better than not using it in terms of Sharpe ratio, in terms of maximum drawdown, and in terms of CAGR, like the returns, the average annual returns. Now, the best indicator is a composite, is combining those two indicators, the simple moving average 200 days and the unemployment indicator. So using the SPY UI indicator, the dark blue one that you see here, the rule is you exit the market only if those two market timing signals tells you to exit the market. So you want to see a decline below the moving average, and you want to see a rise in the unemployment, and only then you exit the market. And you return to the market when either one of them is positive. Okay, the unemployment rate goes down or the market goes up. So you're late using the SPY UI, you're late to exit, but you're early to go in. And actually, you can see the results here. The results here are amazing. I mean, the CAGR is much better using the S&P. It's much better. It's almost twice the CAGR. And the drawdown is lower, and the Sharpe is high. And it seems like such a great system. So let's see a few examples, but let's dive in. Maybe let's dive in first about the signals, and then we'll see a few examples. So this is the first indicator, the simple moving average. So you see here in red, it's the moving average, and in blue, it's the S&P. So the rule says invest when the S&P is above the moving average, and don't invest when the S&P goes down below the moving average. But you see that it's not perfect. It's a very simplistic market timing signal. It's not perfect because it gives a lot of false signals when the market jitters. So you see that during the last decade, it gave us a lot of false signals. Then when you get a false signal, you exit the market, but then you're very late to go in because the market has gone up before you went in. So while it seems good when you have an investing horizon of 20 years, in the short term, it will cause some pain. We see here the second example for the unemployment indicator, and this is an example from the 30s and the 40s and the 50s. And we see here that the moving average here in yellow or orange, it's the moving average of unemployment rate. And you exit when the unemployment, the actual temporal, the current unemployment rate goes above its moving average, and you exit the market when the unemployment goes below its moving average. And you see here that it correlates to the the gray areas. The gray areas indicate periods of recession in the US. So it almost correlates exactly to the recession periods. Now, I've done extensive research, and I've checked those market timing rules with each and every strategy that I have on taldavidson.com, on quantitative value, on microcap trending value, on quantitative momentum, on Graham, defensive investor strategy, on the magic formula, on every strategy. I've checked it. I've done the research. And here we're seeing an example on one of my favorite algorithms, one of my favorite strategies, quantitative value, QV. We're seeing the results. So what we're seeing here is we're seeing QV in dark blue, and we're seeing in yellow the QV with SPY UI. So interestingly, you see that the overall returns are about the same. Even with the SPY UI, they're slightly lower, okay? But they're almost the same. But still, we were able to avoid the crashes during the crashes of the last 20 years. So that's what we're seeing here. So if we look on a CAGR perspective, you see that using market timing signals gives you overall over those 20 years about the same CAGR, about the same yearly average returns, but the drawdown was half the drawdown of using the QV without any market signal. But it doesn't mean that market timing is perfect, because you see that when you use market timing signals, meaning you invest according to this yellow line instead of the blue line, you see that there are periods of years, long years, when there is a gap between the natural algorithm results and the one with market timing. So there's a penalty. Actually, the rule is you will lag. Using market timing, you are likely to lag behind the natural strategy until a market crash happens. And then you gain again your advantage. So it's not a perfect strategy. So the question is, why do I invest only 50% of my capital according to these market timing rules? If they're so good, then why not go 100%? So I want to discuss the downsides of using market timing. So one downside is what I showed you just now, is lagging behind the natural strategies for years, maybe. And we don't know what will be the future, but it's a possibility that the strategy will lag until a market crash comes and evens it out. And the second important aspect of why I don't use it with 100% of my capital is that it is not statistically significant. So I know that many bloggers and newsletter vendors and so on, they sell you this notion of they've done some research and they have some anecdotal evidence and they tell you this is it, it's proven. I'm telling you, I'm a man of engineering and science. It's not statistically proven. So we have evidence that it works. It looks like it works well. It looks like it has merit, but it's not significant in a way that I've not tested it for 200 years. Had I had 200 or 300 or 400 years of market data, I would be able to tell you, hey, it worked over 200 years. But having tested it on 20 years with only two major market crashes, I can tell you we have good evidence that it works well, but it's not statistically significant to the extent that I can say that it is proven and it will work well every time moving forward. But we have to base our decisions in the present according to the data that we have and the uncertainty that we have. So I think that the rational decision is to diversify the decision, diversify the outcomes. So I'm using half my capital, staying fully invested, like in my old system, fully invested during this crisis and every other future crisis, God forbid. And half of my capital, I'm using the market timing signals. I'm using the signal SPY UI. I'm diversifying my decision, half and half. This is why I sell only 50% of my capital. And actually that's what I did. That's what I've done recently. I've sold some of my holdings during the beginning of the crisis when COVID-19 just emerged. But you know, the crash was so quick that I didn't have the chance to sell all the things that I wanted to sell. And I've used the appreciation of prices during the last week to sell an additional bulk of investments of stocks that I'm holding. And today I'm about 50% in cash and 50% invested in long-term assets. On my website, I have a web page under education and tools. So it's the first one under education and tools, where I'm updating every week or 2 weeks the market timing signals, the SPY signal, the UI signal, and the SPY UI signal. And that is available to premium members. It's not available to free members, which some of you are. So that's what I'm doing for investors, and I'm constantly monitoring those signals and updating this page. Now, let's talk about optionality. Let's talk about anti-fragility, about the chance to make life-changing returns. Now, what I'm showing here in this chart is backtesting results of a portfolio that I've created using my screeners, the screeners that I have on the website, specifically quantitative value and quantitative momentum. So it's like a combination of part of it is 60% is quantitative value, 40% is quantitative momentum. One of my favorite strategies, and I've written a lot about it. And I'm showing you the chart of the backtesting during the last 20 years. And what you see here is that after the last crash, the decade ago crash of 2008, 2009, stocks soared multi times. So you see they went up from below 400, maybe 300 to 2000s. That's almost a 10-bagger for the entire portfolio. And some stocks were going up 1,000%, 1,500%, astronomical numbers, because that's what happens when you emerge out of a major crash. Now, no one of us can really time the market. All those signals that I showed you earlier are doing a good job, but they're not perfect, as I've shown you. But the idea here is that if you have cash aside, if you have this dry powder of optionality, then you can deploy it when pessimism is at its peak and earn returns like 100%, 200%, 400%, even 800%. Those returns are possible, but they're possible only to those that have cash aside. Now, during the 2008 crash in 2009, I wasn't that smart. I was fully invested. So I didn't have the optionality. I was seeing the prices, I was seeing the bargains, and I didn't have any money left to buy them. But that's a learning experience, and I'm sharing that with you so you won't make the mistake. If we're bound to crash with the market now, keep some cash aside, and you'll thank me when the prices will be dirt cheap and you want to buy. Now, I'm saying, COVID-19 is horrible. It's a horrible disease. It's not funny. People are dying. But for our families, if we can set some cash aside and deploy that cash when we think that pessimism is very high, then that can be a life-changing returns for us and for our families. How do you know that the market has bottomed? You don't. You don't know. If you're using market timing signals, you will know when the market is going up, when the market is emerging, but the bottoming happens before that. And that you don't have any indication. You don't know that the market is bottomed, and probably none of us can time the market. So rationally, each one of you can have its own system of buying gradually as prices drop. Like I've heard one investor saying that he's monitoring the Shiller PEs, like the one I showed you with Shiller PE equals 26 today. So when the Shiller PE declines by 15%, it will buy with a fifth, with 20% of his cash buy. And then when the Shiller PE will decline another 15%, he will buy another 20% of his cash buy. So that's kind of systems that each one of you should design for yourself. I'm not going to provide a specific personal investment advice. I provide you the data, I provide you the system, but you make your own decisions. The framework that I want to advise on is being rational, is planning ahead, saying, I'm saving this cash pile. Every time the market goes down by X% or the valuation goes down by X%, I will deploy some of my capital. Or you can say, I will not deploy some of my capital. I will wait for the market timing signals to show positive risk-on signals. So I know that I may miss the bottom, but I'm fine with that. I want to go into the market when I know that most chances are that it will continue to appreciate. Each of you will make its own decisions. You are big boys, and I want to provide you the information and the mindset of thinking rationally. Now, I want to give you another piece of advice on how you can be prepared. Use the time in quarantine, in isolation, to learn. And actually, during the last few days, I've done significant work on my website, and I want to show you some. And I'm providing you more information and more data that you can learn from. So in the website, I'm looking at the dashboard, and this is how a premium member dashboard will look like. So I've added a roadmap to consistently finding new and compelling investment ideas. I just want to go through that quickly. So that's an article with a lot of links ordered by order of complexity and priority. So you can read this article and go over each one of those links, which are ordered here, and learn about another aspect. And then you have kind of a table that summarizes the various strategies that I have on the website. And each one of them tells you what it is, and you have links to additional articles. So there's a lot of material, and a lot of articles are here linked to additional articles. Like if you see here, there's so much information in this website that you can read and learn about those strategies, and it will help you become better investors. So in addition to this roadmap to consistently finding new and compelling investment ideas, and I have all those, I've refreshed my strategy screeners. So now the tables look brighter, they're organized, and I've done some improvements. So if you want to see how, what premium members see, so I have here my quantitative value screener, and you see here there are 122 entries. Each page shows 10 entries, so you can scroll between those entries. And then I have here value metrics, which are very important in blue, and quality metrics in purple. And all of those are ranked according to the quality rank, the proprietary quality rank I have. And we have sliders so you can use this to screen and filter more. You can click on each one of the columns to sort the table according to the column. And those are the results of very sophisticated algorithms, which I update every week. The prices are updated real time. The valuation metrics are updated in real time, but fundamental data is updated on a weekly basis. So that's for people who want to find investment ideas. Then I have the Quant toolbox, which is a tool that I provide to people who have some investment ideas. They're either holding the stocks or they're considering the stocks for investment. And this Quant toolbox is a tool to help you analyze, do the research. So you can search for tickers, and I have here a database of almost 2,000 stocks. And for every ticker, I provide a very hard to find data. And some of it is proprietary data, like a value rank, quality rank, and momentum rank based on my sophisticated ranking systems. And then valuation metrics that you will not find anywhere else, like the VC2 rank or the EV to EBITDA rank or EV to EBIT rank, and the 5 years minimum of that and 5 years maximum. You will not find this data anywhere else, certainly not for free. And quality data with my proprietary quality rank, and a bunch of other data, including momentum data and idiosyncratic momentum data. Is very advanced. And the last thing I have here is information on building a winning stocks portfolio. So I have a roadmap to building a winning stocks portfolio with guidelines and a lot of information on answering 9 questions that you need to answer if you want to build a prudent, rational, winning stocks portfolio. So you see here, there's a lot of data and links to additional stuff. You can spend tons of hours in the website to learn and become a better investors. So my website is designed for people who enjoy reading and enjoy becoming smarter and becoming better investors. And the last things that I want to highlight here is that I have a page called Stock List for Quant Portfolios. Now that is available only to premium members, but it's the outputs of my algorithms, the outputs of the screeners to help you invest easily. So here you decide on the number of stocks to hold, you select your strategy based on all the other material that I provide, the roadmap and so on, and then you buy the stocks. And if you decided, let's say, to buy quantitative or deep value stocks, then you have here the stock list ordered according to the order that you should buy the stocks. And when the time comes to rebalance the stocks, again, you have here the tools you need, the lists you need, the search databases that you need in order to know which stocks to sell and replace them with which other stocks. So use the time, let's go back to the presentation. Use the time to learn and become better investors. You don't need to trade. We're not traders. We're not trading every day. We're not looking at our portfolios whether we should buy or sell. We're long-term investors. So what do we do with our spare time? We learn. And then build a cash pile. We've discussed that. We've beat that to death. Build a cash pile and create a wish list. So use the time to go into my website. If you're a free member, you'll see only the top stocks. If you're a premium member, you'll see my entire stocks database. And go and make wish list of stocks you want to buy. Stocks you're saying, hey, this one is cheap. This one is something that I want to buy, and I'm looking forward for it to be even cheaper. And when the time is right, act with conviction. So if you use the time to learn and become better investors, to build your cash pile and create a wish list of stocks that you want to buy with this cash pile, you almost have no chance of losing. And when the time is right, when you feel that stocks are too cheap to ignore, then act with conviction. And conviction is more important than anything, because when you act with conviction, you sleep well at night. You know that you bought cheap assets on a diversified basis, and they don't have to be quality assets. Okay, some of my strategies are for investing in junk stocks. They don't have to be quality assets. But when you know that you have a diversified stock portfolio of cheap assets, you can sleep well at night, because you know that looking ahead 3 years, 4 years, 5 years, 10 years, you're going to be much, much richer than today. So this is my message to you today, and I want to end my presentation here. And actually, this is the first discussion that I'm doing in Zoom, so let me try to track my chat box and see if anyone has written anything. I'll stop my share and try to find the chat box. Okay, so I'm available for you now. If you have any questions, you can ask me verbally or in the chat box, and I'll be happy to do my best and answer. So don't be shy, go ahead. You can type your question in the chat box, and or unmute and ask me directly if you have any questions on what I just said, or on my website, on my services, on everything I do, on who I am. Let's do it as an AMA, ask me anything. And if there are no questions, then we'll end it for today, but I want to give you the chance to ask questions. If you feel uncomfortable, then you can shoot me an email. So I try to read and answer every email I get. So don't be shy. Just shoot me an email, click reply to any email I've sent you.